Welcome back to the Florence School of Banking and Finance YouTube channel. Now, for the past 15 years, Chinese growth really has been the energy of the whole global economy. But now that it's slowing down, how is it going to affect banks in Europe? Today I'm joined by Piers Haben, who is Director of Oversight here at the European Banking Authority in London. Piers, how important has Chinese growth been to the banking sector in Europe over the last 10 years?
I think Chinese growth as part of global growth has been very important, and we are often asked questions about how changes in the global outlook will impact EU banks. And the way that we answer those questions is in the following steps. We first of all ask ourselves, well, what is the direct exposure of European banks to the issue? So in this case, China. And I happen to know the answer to that, and it's actually on our website, because we work really hard to publish data on EU banks' exposures. We think that's important for market discipline. So if you look at EU banks' exposure to China, you can look it up and find out it's 626 billion euros. That looks like a lot of money, but as a proportion of total EU banking assets, that's just 2%. So if you ask me the same question about Brazil or about Russia, I would tell you, well, the answer is 321 billion euros and 1%, or 130 billion euros and 0.4%. So we can easily understand the direct channel, but that doesn't tell us very much, because there are other questions that we should be asking ourselves. Firstly, even with those broad aggregate figures, which banks are most exposed? And again, for China, for example, you can drill down and find out that there are a number of banks that have much bigger exposures as a proportion of their assets than those aggregates I told you about. And that's why we work so hard with supervisors, so that there are plans in place to deal with potential problems. And we focus very much on indirect exposures. So we look at, for example, asset prices. What happens when Chinese equities go down? We have seen that equity markets elsewhere go down. We have seen that commodity prices go down. And for us, there are a couple of challenges there. There is volatility, so rapid movements in these asset prices, as well as the absolute fall. And that's why supervisors monitor very closely banks' trading portfolios. But I think the really interesting part of this indirect exposure then is the medium-term outlook for growth. As China slows down, we'll see other emerging markets slow down, and I think it's very likely that we'll see slowdowns generally across the world. That has implications for banks' loans. As income falls, there is always a possibility that people's capacity to repay the loans that they have from banks falls. Now, we try not to model every single individual potential bad outlook. What we do is a stress test which looks at what happens to banks' assets if there is a general slowdown in the economy. We did a stress test in 2014 which looked at that, and we'll be doing another stress test in 2016 that looks at this. And sometimes we're asked, well, have you modeled a precise China slowdown? Actually, they ask us, have you modeled a precise, whatever the topic of the moment is, a Russia slowdown, a Brazil slowdown, an Ebola outbreak? And our response is, we think it's important that supervisors have all the information necessary, and they're able to do a stress test that looks at a broad slowdown so that we can understand the vulnerabilities of EU banks. That's why there's been so much work in recent years to restore banks' capital levels. We've seen banks' capital levels rise from around 9% core tier 1 to around 12% core tier 1 now, so that they have the capacity to withstand bad times and continue to lend into the real economy.
So presumably we should anticipate a diminished European banking sector.
Well, if global growth does slow, and we see this impact economies both in Europe and abroad, you can expect there to be some diminishing in economic activity. In turn, you can expect to see non-performing loans increase perhaps. I think then looking at what that means for the European banking sector, we need to think about the following. Firstly, are there sufficient buffers in place to absorb those losses? And I think we've done so much to strengthen both capital and liquidity buffers that there are more buffers than previously in place to absorb losses. But in terms of diminishing, we often think of then shrinking. And I think it's very important that we don't say, well, I know exactly where it's going to shrink, but it's also very important that we have the mechanisms in place to facilitate both entry and exit into a banking system. A competitive market requires free entry and it requires exit. And to that end, not only are there buffers in place, but it's also important that we have effective recovery plans and also effective resolution plans. So if, and I don't know if a bank will become unviable, but if a bank became unviable, it can be resolved without impacting the broader economy and the broader banking system.
Okay, well, just don't look down. Piers Haben, thank you very much.
Thank you very much.